So let me introduce today's panel. We have Sarah Williams, Chief Executive Officer from FCLT Global. Sarah, you're there. We have Richard Manley, to my left here, Chief Sustainability Officer of CPPIB. Genevieve Piche, Head of Sustainable Finance and Advisory from Wells Fargo Corporate and Investment Bank. And we have Chris Weber, Head of Climate and Sustainability Research from BlackRock. Okay, now the Global Stocktake Report obviously is a high-level report, related, I guess, to countries and more like related to global policy. And we are here more in a private sector capacity. And I would like to hear from all of the panelists, when it comes to sort of almost like taking stock from your point of view, your business, what would your analysis be? How far have we come and what is still needed? Maybe just in the order of, from right to left from our point of view. Okay. So, Richard.
We're in New York, so I'll give a US analogy, somewhere in the second innings of a baseball game. So I know human instinct is to say we're maybe in the seventh or eighth, but I actually think that's really dangerous because hubris is not going to help us get to net zero. I think pragmatism and an appreciation of the challenge that we have ahead of us is really key. So I think we're very early in this, and I think as maybe today we'll talk about some of the tools available to us. I think we need to be really eyes open to the fact that these are first and second generation approaches, and that as we move through this decade and into next, I'm sure we'll look back at the things we have on our desktops today and maybe hopefully laugh that they are as basic as they are. But I think what's also important today is, and I think this is an important change versus where we were 2 years ago. 2 years ago, it felt like the financial system was being co-opted to pursue a divestment agenda. You've probably all heard the phrase, you can't cut your way to growth, you can't divest your way to net zero. The only way the financial system can support the real economy is actually investing for its decarbonisation. And I think that conversation is now live. I think we saw that yesterday with the guidance from Treasury, the principles on transition financing, that the financial system here needs to be mobilized to invest. It's a more sophisticated conversation. I think that conversation is live, but I think we'll be having this conversation for still many years to come.
Thank you, Sarah.
Yeah, thank you. Where I sit, which is, so FCLT Global is a nonprofit that has members who are corporates or asset owners, big pension plans and sovereign wealth funds and asset managers. And what we think about a lot is what can the business and investment community do? So it's very important, obviously, to have government action, and where we hope that continues, but it's not an excuse for not getting going. And so the way that where I think we are right now is that the companies and investors have all recognized essentially that climate is real. They've all been hot or wet or whatever this summer, or on fire, and they understand that. And they're trying to figure out how to thrive in a world that's changing. So in a world that's decarbonizing, in a world that will perhaps have carbon pricing, and that perhaps have all sorts of other things in the future. So I think that where most investors and companies are is they're not discussing is this important or any of this stuff. They're discussing how are we going to win in a very different world than what we're in today. And yes, we can have scenarios and maybe different scenarios, but the direction of travel is very clear. We're having more weather events, it's getting hotter, regulation is getting stronger, and the geopolitical issues around climate are getting hotter, if we can call it that. So I think that is where we are, and I agree with your second inning analogy. I'm impressed with your baseball analogy there, Richard. Very good. We've got a long way to go, but business and investors are thinking about how they're going to compete in this world.
Chris?
Well, not to not to pile on, but I was actually going to even use the early innings analogy. So like, it is what it is. We are obviously early on, like in the transition. We're also early on in the private financial sector understanding its role, like vis-a-vis public finance, and how different types of financial institutions have different roles to play. There are certainly positive, encouraging signs. We are seeing a lot of interest from clients. We just did a large survey of our biggest institutional clients around the world, 200 of the biggest investors in the world, and 56% of them said they are looking to increase their allocations to transition finance over the coming 1 to 3 years, which is a lot over a relatively short time period. And notably, that was true across regions. This is not just a European story anymore. This is very, very much of top of mind in APAC. It's top of mind in the Americas as well. There's still a lot. There's a lot to be done. There's a lot to be figured out, as we're going to talk about as we go, in terms of what specifically that means, how to play this mega trend as it unfolds. But I think that I'm getting increasingly optimistic about how private finance is going to play a role.
Thanks, Chris. Genevieve,
Okay.
you're a baseball fan?
So I was going to say I'm Canadian, so I do better with hockey analogies and like where the puck is going, but I'm not going to do that one. I think my analogy, I have maybe two. The first is that I think we're kind of in the teenage years. So we had this irrational exuberance around this topic, and now we've hit a bit of a dark, brooding moment in some ways, where we are defining our identity. We are learning how to function in this brave new world, and we will emerge from this as far more sophisticated adults with a much better understanding of what we need to do. So I would characterize us as being about 14 or 15 years old. And the other is that the automobile was invented in 1885 in Germany, and it took approximately 30 years for cars to outnumber horses on US roads. 30 years. What are we talking about here? We're talking about roughly 30 years to net zero. It is the same large-scale transformation that occurred then that will need to occur now. But think about what had to happen. You needed to widen roads. You needed to build stronger bridges. You had to develop the technology. You had to install fossil fuel pipelines to get gasoline where it needed to go. You needed to upskill people who did horseshoes to people who fixed internal combustion engines. And the transformation was rapid, and we are right at the beginning of that transformation. But the opportunity is clear. It took a tremendous amount of capital to make that happen, and now our economy is multiples the size of that. So you can imagine the amount of capital that will be needed to do what we need to do in the next 30 years, and it is super exciting.
Brilliant analogy. So let's stop making saddles and let's move from just kind of a general outlook to some of the more practical solutions. So Sarah, you advocated, for a really interesting proposal in Forbes. You said investors should implement a shadow carbon price. Can you explain that for the audience a little bit?
Yeah, thanks. So I think every economist that I know, I probably, including myself, loves carbon pricing, right? We all think it's, it's a solution to all the world's ills. Every politician I've ever met, with exception of a few Europeans, hates it because it's difficult. People who've tried it get voted out of office. It's challenging. So one of the things that we've been thinking about is, again, the political process will do what the political process is going to do. But how do companies and investors implement shadow carbon pricing in their own businesses? Now, many large companies, as you probably know, when they're thinking about capital allocation for the future, they think about Project A or Project B, which one they're going to choose. perhaps they look the same without a carbon price baked into it, but maybe A looks much better than B if you assume in the future we're going to pay. There's going to be some sort of carbon price. So I think many large companies are already, and small companies are already doing that and are doing it quite effectively. It's not a universal practice. But as an investor, which is, we've spent a lot of time telling companies to think about these things, but haven't spent as much time looking in the mirror and saying, what can investors do? And with a few exceptions, perhaps on the stage, not many investors are really thinking about carbon pricing for themselves. So the two simple ideas that we are trying to get people to think about, first is for asset managers. For those of you who know the SEC mutual fund rules, as an example, if you look in an SEC prospectus for a mutual fund, you will find the actual returns of the fund, and then you will find estimated after-tax returns. That's a requirement. Now, those estimated after-tax returns may not be exactly your taxes or my taxes, and they're not perfect. But they're an indicator that if you were looking at, choosing to invest in mutual fund A or mutual fund B, and you're a taxable investor, you would get a sense that perhaps one is much more tax efficient than the other. We think you could do the same thing with a shadow carbon price. So perhaps there are two funds and they look very similar on the surface, but you can start to price carbon into returns, quote returns. Now, I understand it's not real money, but people are motivated by competition, and that's a way to have people compete, which is more economic and gets us out of, you mentioned divestment, Richard, kind of the yes-no world into the optimization world. And I think the same is true for asset owners. There are a lot of asset owners who are trying to get to net zero. The easiest way, as you know, and not the best way to get to net zero, is to sell the dirty things to somebody else, right? Get them out of your portfolio. But we all know there's a fundamental difference between investing for a green portfolio and investing for a green planet. And what we're after is a green planet, not a green portfolio. So the other idea is if you do a shadow carbon price on a portfolio, you can tax yourself and then take those dollars and put them either to green investments or, for example, if you're a university, towards scientists who might actually figure out some solutions to the problems that we have. So we're big believers in trying to have as much of a market mechanism as possible, and this market mechanism is not perfect, but we think it would work a little better than no market mechanism, which is where we are in most countries today.
Fascinating concept. I think we could talk a whole panel on that idea and all of the different flavors. The other tool I think that's out there obviously has sparked huge international debate is the Inflation Reduction Act, the IRA. So Genevieve, how is Wells Fargo's business mobilizing capital and motivating clients to invest in the climate transition, exactly that investment that you talked about, and how does the IRA fit in?
Yeah, so to put a little bit of context to where it is that I sit within this financial ecosystem, I am leading the sustainability effort of Wells Fargo's commercial and corporate clients, which means that we have access to millions of American companies. And these are small to very large companies. We are a very relationship-oriented financial institution where we are building relationships with clients over many, many years. And the Inflation Reduction Act has been a huge catalyst for many companies in our client base because it is providing, as you all know, some interesting tax incentives, but there is also sidecar arrangements with the Department of Energy and others that are really providing some very reasonably priced capital for companies that are in critical emerging sectors. And the Inflation Reduction Act is playing a super important part in the financing of the transition, which I in some way believe is the special sauce that we need globally to enable this transformation, and that is the concept of blended finance. Blended finance is essentially a way of combining public or supranational type of capital with private capital. And the largest organizations that have been doing this are organizations like the World Bank or the African Development Bank, the Asian Development Bank. There are many of them. And that capital has been essential to de-risk or take kind of like that first mile risk on some important projects and technologies with a very sort of social and environmental mindset. And it has allowed us to partner with our clients and with the Department of Energy and others to figure out how the private capital fits in along with some of this early stage public capital. And it has really created such an incredible opportunity for conversation across multiple areas, including tax credit transferability, aligning ourselves to some of these early stage technologies that have been supported by the Inflation Reduction Act. And it's really creating our opportunity to look at our huge client base and focus our sectoral coverage efforts and our insights and product development to support some of these key areas.
Thank you. Chris, I think you're the main architect of the BlackRock transition scenario that just came out, right? So congratulations, really astonishing, depth in research. Is that the main tool now that BlackRock is using, or do you have other tools that you'd like to mention as well?
Well, thank you for mentioning that. No, I don't have to. First, important to start from the context that BlackRock's huge, right? Our clients are a very diverse set of clients across the world. They have different objectives, and we deal with sustainability and transition just the same way we deal with everything else. We've taken to saying it's just investing. This is an investing problem like any other, and as such, we treat it the same way we do anything else. We start with the client, understand their objectives, try and maximize risk-adjusted return for them within the mandates they give us, and underpin that all with the types of research that you're talking about. Different objectives, of course, require different tools. If there is, I'm often one using the sort of hammer-nail analogy, right? Not if you have a hammer, everything looks like a nail. But this is really a situation where you have to kind of understand the depth of kind of what clients are interested in with respect to the transition, because helping a client achieve their net zero objective is a fundamentally different problem than helping them kind of minimize transition risk, minimize physical risk, or maximize opportunity in the transition. Regardless, we think there's sort of a few key elements that fit into any of those objectives, one of which is understanding in a very detailed, nuanced way how the transition is likely to unfold. And that's exactly the research we have been conducting over the last couple of years, doing a really in-depth assessment of the underlying drivers, the policy, the technology, the consumer and investor preferences that are going to shape the transition over the coming few decades. But that's not enough, obviously. Some clients want to layer that within a net zero objective and want to understand the difference between the likely transition path and a net zero path. And what would that mean if I was going to decarbonize my portfolio at a certain rate when the world is decarbonizing potentially at a different rate? There's a lot of very complicated questions here to answer, and we think that there's, as I think very strongly agree with Richard, the toolbox is really still being developed here, and we think that understanding the transition at a very rigorous level is step one. Then you have to kind of connect that to issuers and understand what do those underlying trends mean for different issuers that are positioned differently and looking in their transition plans to position themselves differently through time. And then crucially, third, you need to ask what's already priced in. Because obviously understanding the secular trend by itself doesn't help you if all of that secular trend is already in the price.
Richard, the way I know you is that you always have really good views on hard problems. And the hard problem in climate change is decarbonizing the hard-to-abate sectors. So what do you think we have to do? Which tools do we have in our toolbox for the hard-to-abate sectors?
Okay. I want to frame this in just in terms of, first of all, just why hard to abate. I think one of the challenges we have at the moment is a generic belief that a ton of CO2 in a portfolio is generic. A ton of CO2 because the company leaves the air conditioning on at night. A ton of CO2 because the company keeps a life support machine switched on. A ton of CO2 because a company manufactures steel. Or a ton of CO2 because a company is flying a plane are very different. That first ton you can address overnight. That second ton, you can't stop it, but you know the technology to green the energy system is clearly there. It's a matter of building the supply chain to make sure we can deploy it at the scale we need. The ton of CO2 in steel, you can actually abate. We have green steel now going straight into the automobile manufacturing chain in the European Union. The steel costs 30% more to manufacture with no carbon. It adds 2% to the price of the vehicle. So the issue there really becomes, how do we actually create the right incentives to change demand in order to stimulate the expansion in the supply of green steel to get things done? The last ton that I alluded to, which was the plane flight, that's really tough to do because it either means changing how we make the fuel or it means changing the drive chain of planes. Aviation, rightly, is one of the most heavily regulated industries on Earth. We don't want to put people in the sky unless we know we're going to bring them back down to Earth safely, and that is going to take some time to fix. Now, it's not out there at the moment, but one interesting thing we could do, is it requires a bit of a change to the greenhouse gas protocol, is at the moment, carbon accounting is done through a P&L. Everything is effectively expensed in year. In the financial system, we don't just use a P&L, we use a P&L, a balance sheet, and a cash flow statement. And bizarrely, cash that you invest into fixed assets, people obsess about driving down the cash they invest because they know the capital invested will be the denominator returns for the rest of the life of the asset. Just imagine if you capitalized embodied emissions into any fixed asset, and instead of leaving the emissions on the P&L of the steel company, the cement company, the glass company, you put it into the operating emissions of the customer of the end product. So you build a new building, embodied emissions, now add it to scope 1 of the tenant, that you don't just have the emissions associated with powering the building, you have the emissions associated with amortizing the emissions in the building. I guarantee you the first phone call that happens when that is done is to the architect, to the developer, to say, I need you to drive down those tons of embodied emissions because I don't want that sitting on my P&L for the next 25 years. But more importantly, and this is a really abstract financial concept, I don't want to be short volatility on the carbon price for the next 25 years. Because if short volatility on the carbon price is it goes up $2, that's noise. If short volatility on the carbon price for the next 25 years that I'm a tenant of the building is it goes to $300, I need to make sure there's as few emissions in that building as is practically possible. So I think that there is an accounting fix there that would dramatically shift the demand curve for effectively green materials that would in turn, look, it would take some time. I think Genevieve made a great point earlier on. I think there is a perception that the energy transition is digital 2.0. Like we're all very accustomed from the last 35 years of economic growth that you expand capacity by pushing it into emerging markets or building it in the cloud. The only mine you can build in the cloud is a Bitcoin mine. We need copper mines. We need smelters. We need fabrication capabilities. That is going to take time to build because this is not digital 2.0. It's industrial revolution 2.0. This is effectively replumbing the economy. But I think if you create the right incentives to shift demand curves, provide a very clear signal to the prospective suppliers of these technologies that demand was in place, then you get the benefit of the IRA. It's not great to live in Britain and walk around talking about the IRA. I prefer to call it the Rights Law Acceleration Act because this is actually going to inspire innovation. It's going to result in the construction of manufacturing capacity in the United States. We all know that as you double the installed capacity of a new capability, there's a constant reduction in cost. And I would anticipate that what we will encounter over the remainder of this decade is the unit costs of the technologies that are incented by the IRA are going to fall just as we saw solar, wind, and storage over the last 15 years.
Yeah, thanks, Richard. I knew it. I knew that we would hear a really interesting, intellectually inspiring idea. So let's continue later to talk about that change in carbon accounting. Chris and Genevieve, physical risk and adaptation is another one topic where we need tools. Do you have brilliant Richard-like ideas on those ones?
No, you go first.
Oh, okay. All right. Do you have a brilliant idea? It's a tough lead into a question. So no, obviously, physical climate change is having a banner year. We've already seen the most billion-dollar disasters in the United States, 4 months left in the year. It's very likely, not very likely, it's likely to be depending on who you ask, to be the warmest year on record, possibly breaching 1.5 C for the first time. And obviously, interestingly, we've started to see markets react too. Like we've seen these high-profile insurance in events in Florida and California in particular, with big insurers leaving markets that they no longer deem as insurable. And definitely people are taking note, the markets are taking note, the insurance industry is taking note. I think that there's a lot to be done still on the analytics and data front to understand better, how these changes are coming, how the hazards are changing, how exposure may or may not change, how adaptive capacity may or may not change. Over time, connecting them with different asset classes. It's a giant multi-year problem that we are researching within BlackRock and our Aladdin platform and with partners like MSCI. But we also think that there's a big opportunity, and physical risk is almost always framed in the risk-only side. But we think there's actually a pretty big opportunity in resilience as an emerging investment theme. Really great discussion at the MSCI Sustainability Institute launch last night on this very topic. This is a trend line that we're pretty confident in over the next 10 years. Climate change is going to keep going. We're almost regardless to how much decarbonization we do over the next 10 years, there's going to be a good chunk of warming added, a good chunk of emissions added, and a good chunk of additional risk. And that means that there is opportunity in resilient solutions. And there's a lot of interesting work happening now in trying to kind of find how private markets and public markets can play in that space that has historically really been thought of as a public finance problem.
I think we live and breathe climate and sustainability every single day. And when you go out into the world and you talk to people, they don't always understand what it is that we're talking about. And it's super important that we find ways to translate all of these concepts into words and concepts that are comprehensible to people who only maybe stick a toe in from time to time or read an article. Physical and transition risks are sometimes difficult for people and companies to get their heads around. And I heard a great quote yesterday from the Prime Minister of Barbados at the SDG Pavilion, and she said, "Ambiguity is the weapon of those who seek to maintain the status quo." And therefore, we must get very specific and granular about what it is that we're doing. And as we speak to our clients, we are trying to identify value creation opportunities in using words that they understand, like capital expenditures or operating expenses or margin expansion or asset value, builds. And these are words that our clients really understand. When it comes to risk, take biodiversity risk, which is one that we're all trying to get our heads around. We have spoken to some of our clients in the consumer business, in the apparel business, as an example. And biodiversity risk is big for these companies because the apparel that they make is cotton, for example. Cotton is grown out in the world. And if you haven't properly looked at where your supply chains sit within this global changing climate, you could be at substantial risk. So it's a way for companies to really understand where they have vulnerabilities within their own operating value chain. Speaking in plain English, and then asking, and then providing them with some solutions with, of how they might do. Sometimes it might be a financial solution that we have. Otherwise, it might be they have an idea and they can take it away and figure out how they can make themselves more resilient. So it's really trying to convert these concepts into these complicated concepts into those that anybody can understand.
Yeah, thank you, Sarah. I've got a question for you. Another tool in this toolbox of investor solutions to climate change is more long-termism, kind of changing short-termism to more long-termism. Well, you talk to a lot of long-term investors. How do you think we can infuse more long-termism in general, in our industry? What traits do long-term investors have, that make them look at the long term?
Yeah, so our organization is called Focusing Capital in the Long Term. So we spend a lot of time thinking about this. So I think that the underlying premise is that that short-term noise distracts people and sidetracks them from achieving their long-term goals. And we see that in the financial markets all the time. And so if you're investing for this afternoon, you're for 2 seconds from now, you're never going to get to the issues that we're talking about. And so a lot of the work that we've done over the last 7 years has been about how do you lengthen investment time horizons? How do investors lengthen investment time horizons? How do you have broader business objectives? In other words, let's create long-term value but not destroy the planet at the same time, for example. And how do capital markets become a force for greater economic mobility, which they often aren't. But I think that the ways to be long-term we can talk about, they mostly come down to governance, incentives, metrics, the investor-corporate dialogue, and sometimes public policy. And I'm happy to go into any of those in real detail. But I wanted to just come back a little bit to, and you mentioned this, Genevieve, the sort of the language that we're using, because I think a lot of this is in that framing of the long term and framing this as long-term value creation for companies, investors, savers, and communities. And I think that we as a sustainability community, for lack of a better word, have not done a very good job translating the concepts we hear and we know at the UN or in public policy environments to the business and investment community. And I will give you the simplest example. I think it would be hard in the middle of the United States to come up with a worse marketing pitch for combating climate change than we need to keep emissions below 1.5 degrees Celsius to align with the UN Accord signed in Paris. Like, I challenge you to come up with a worse marketing pitch. So, we don't use Celsius in America. I know that sounds ridiculous, but you talked about having, and I know I've got Canadians and Europeans, they use Celsius. But if I went to Europe and, advertised a thermostat in Fahrenheit, you all would think I was tone deaf, right? So I think that the point here is the world is changing. And if you have any kind of long-term view, whether that is for your business or your children and your grandchildren, we need to change this world. And it's not about, the elite people in certain places talking about, Celsius and all sorts of things. It's about how do we get the middle of America to embrace this. And I think, Richard, back to your point on the IRA, that's actually working because people are building battery plants and there's jobs and so on. But I think that we need to challenge ourselves to address the fact that a lot of us have really been unclear about the difference between a belief-based system. We believe in, we have to recognize that most of the responsible investing world came from the faith-based community. And so a lot of this comes from the original words and the original structures come from religion. So people didn't buy gambling stocks, for example, because gambling was bad. They didn't think they were going to affect gambling. They just didn't want to own it, right? So that's one reason, is you just don't want to touch it. If it's landmines or whatever, you just don't want the money. Very valid, but different than an impact mindset, which is somehow you think you can change something by investing. And I think many of us would like to do that, but we have to think really very carefully about what that pattern is to change. And then the third is long-term value creation. So I think being long-term is the foundation for all of these things, but I would just challenge us as a community to think about making sure that that is coming across rather than trying to get business and investors to carry out the public policy that somebody else wants in place.
Thank you, Sarah. We're at time already. Time's flown by, so let's wrap up here. COP28 is coming up, in December. We're in the middle of Climate Week. I'd like each one of you to share your short-term or long-term expectations until the end of the year, I guess would be good. Yeah. Let's start with you, Richard.
I think many people say it's long overdue, but I would expect the oil and gas industry is going to come to COP28 with a pretty big commitment. We've probably already seen that LNG customers are asking for line of sight of the emissions in the gas that's going into cargoes. You've got to believe they want to know that because they want to work out how they can effectively change the gas going into the cargo so they can drive down their upstream Scope 3. If that is a precursor to discriminating for international gas prices, that clean molecules get a premium, grey molecules get a discount, the energy system is about to get an economic signal that it needs to decarbonize, taking out fugitive methane and Scope 1, 2 emissions in production, processing and transportation of fuels. That is an absolute game changer, and I think the energy industry is very clearly preparing itself for structural shift in the industry.
Wow. Sarah?
So I would say that one of the things we haven't talked about today, there's a lot of conversation going about, is the just transition and how we get financing to lower and middle income countries. And I know you talked a little bit about blended finance, but we have a long way to, maybe we're in the second inning on things broadly. I think we're, I think we're barely, putting the team on the field on this one. And I think that this is a space where the financial community can really add a lot of value, because one of the things that we know how to do is slice and dice risk and return for different people, and that is one of the many things that is required to get funds flowing beyond just the IRA and the Europeans and so on.
Well, I think the last couple weeks we've seen kind of two big things that I think presage what's going to happen by the end of the year. The first is the stock take. The second is the G20 communique. And I think what is in and what is not in the G20 communique is fairly predictive of what we're going to see coming out of COP. I think in the next couple years, obviously the big question is going to be whether the stock take has, the report card effect that it was envisaged to have. Obviously, the findings themselves are nothing new. Every IPCC, IEA, UNEP, UNFCCC report has said largely the same thing. But given this is a self-report card, it's going to be, the question is how does this play out in the negotiations this year and moving into the next year?
I'm not sure that I have any views exactly on how COP will play out, nor exactly what will happen in the next 3 months, but I do feel extremely optimistic that we are seeing some really critical technological developments, some things that are starting to click that will really allow us to progress things around grid technology and smart grids that will allow us to charge vehicles in mass more quickly without shutting down our grids, or some really important developments in hydrogen. And I think it's a very, very exciting time out there. And I would just maybe leave you with the concepts that it's a real economy out there with real people, and using better language with greater clarity will allow us to achieve our objectives much more. And in terms of financial institutions, it's very difficult for any kind of financial institution, asset manager or GSIB or whatever, to fundamentally change their risk appetite. So, often financial institutions and market participants are asked to expand their risk appetite, to do things that they don't normally do. And I would challenge all of us to think about how instead we can work more collaboratively so that everyone is functioning within their sweet spots and creating financing packages that involve various forms of capital right where they are most comfortable, because changing the risk appetite infrastructure is going to be a heck of a lot harder than getting us all to work together.
Richard, Sarah, Chris, Genevieve, thank you so much for all your insight. Let's give them a big hand.